Welcome to the daily update, where I'll go over the action in the market for Wednesday, February 28th, and then we'll see how things look for Thursday, February 29th. We had another narrow range day. In fact, we've had four in a row, and there's been a little bit of research over the years about when we have a narrow range 4, narrow range 7. I remember reading about this years ago in one of the first books that I read, and it looks like we could be building up to something. Whether we're going to spring to the upside or spring to the downside, that is pretty much a roll of the dice right now. The market seems to be waiting for this inflation data that will be coming out on Thursday and the reaction to that, and then sub-reaction, whether we go in one direction and then move in the other way. That could be very telling. But for right now, we're positive. We do have overhead resistance, but we're also in a weak seasonal time. So there's things that you can pick and choose to go either way for right now. Let's go back and talk about what happened. Right at the open, we had a lower open and prices found support at S1, which was at 5,063. Then we rose above the daily pivot at 5,072, and we hit resistance at the unchanged level. That's that built-in resistance on a down day. As the day went on, prices chopped between the unchanged level and S1, and we closed slightly below the daily pivot. A very slow day. What's interesting is in Tuesday's session, we were up 0.17%. In Wednesday's session, we were down 0.17%. So not an awful lot going on there. We were below average with volume. Again, another non-surprise there. We are still positive when we take all of our charts together. We're not necessarily dealing with an overbought situation. We have our stochastics. That's pretty much it. We have our long range moving averages, and that's about it. So the market is kind of free to do whatever it wants. There's some reasons to go up. There's some reasons to go down. In Thursday's session, it will be about inflation and interest rates. If that's going to be the catalyst that the market needs to really move. Now, if the report comes out and it's rather mixed and it leaves the market confused, not much will really be resolved. But it doesn't seem like the market really has anything to move off of, at least for the last few trading sessions. But that can always change. Usually the quieter things get, the more the explosion will be once we finally move. Let's go back and make some comments. We're in wait and see mode. I always thought that would be a great name for a boat, of course, except I would spell it SEA instead of SEE. There's really not much to comment on. We just keep watching our charts as they unfold each day, and we're seeing some changes. Right now, we only have our stochastics that are looking extreme positive. In the intermediate term, not a really long list. We're still getting some mixed signals from our oscillators. The Sean trend meter is coming down, but still rather extreme. And then a longer term study that we look at, which is the 10 period new high, new low study for the S&P, that's been on the list now for quite some time. And our long range moving averages, the 150 and the 200 period simple moving averages. We're still wondering about this current scenario. It looks like the Fed is done raising rates. They're probably going to cut rates at some point in 2024. We just don't know when that will happen, nor by how much. Maybe with the core PCE reading coming out in Thursday's session, that might give some clarity there. The dollar was down and interest rates were also down. We closed at 4.27% with the 10-year yield. The yield curves that we do follow are still inverted. Sentiment is still extreme. We actually ticked up to 79 where we had been at 78. We're getting pretty high there. Once we get above 75, that's when we start to take on the idea that maybe folks are getting a little too happy about things. It's positive in the fact that that could help the market go up, but it's negative in the fact that so many people are positive right now that could end up backfiring. Our trend is still positive. We're still dealing with being right on top of the moving averages. So we don't really know if it's a strengthening trend or a weakening trend. We are still in a trend though, because the ADX is above 20, both with the short term and intermediate term chart. I'm keeping our bias at mixed right now because we had the slight down day after having the slight up day on Tuesday. Our momentum for right now is still positive. We're not really falling apart. We're not seeing a lot of selling coming in. We're not seeing buying either, but the market is holding up for right now. The economic reports that came out, we had the weekly MBA mortgage applications index. It was down 5.6%. Last week, it was down 10.6%. And as interest rates are going back up, that's putting some pressure on folks getting mortgages, whether they're new mortgages or refinance type mortgages. The second estimate came in. There was a little bit of a change there. The headline number was pretty much the same at 3.2%. That's positive for GDP, which is what they had expected, and down a little bit from what we saw last time at 3.3%. So a little bit of a tick lower there. The deflator was actually up. So again, we're seeing some contradiction here. It was at 1.6%. They expected 1.5%, which is what we saw when we got the first reading. The trade deficit came in at minus 90.2 billion. Last time it was at a minus 88.5 billion. Retail inventories, these aren't real influential reports. They were up 0.5%, or last time it was up 0.6%. Wholesale inventories were down 0.1%. Last time they were up 0.4%. Here are some charts. Here's the weekly mortgages that we like to keep an eye on here, where they're declining because they're below zero, but it's less of a decline. But we've seen really 3 weeks in a row now of declining mortgage applications. Here's the real GDP, which takes inflation into account, and the deflator. This is a quarter over quarter. We're still above zero, but we are declining. And this is year over year personal consumption, still above zero, but pretty much flat. The net exports are climbing up just a little bit here, being a little less negative than they were before. And real GDP, again, inflation into account here, year over year, it is showing growth. And so one of the things that we look at for going into a recession is negative GDP, and we're just not seeing that. Here's some Isabel net charts. This is the trend of earnings per share based on a price chart of the S&P, which they're still seeing the trend is going up from here, and that justifies stock prices going up. That's ultimately what drives stock prices. A company has to earn money and then earn more going forward to justify their stock price going up. Yeah, and here's equity fund inflows have picked up along with earnings growth. I'm not sure how they actually make the connection between the two, because folks are putting money into stocks, and how does that necessarily feed over into earnings growth? But they're still having a tendency to go up with each other. And then small caps, we're trying to keep an eye on this. Small caps have been hanging in there a little bit better these days, where folks are still starting to get into small caps, which could be positive for the small caps overall. And then the financial conditions, we are seeing a real loosening of the financial conditions, which could allow for more money to be flowing throughout the economy, which sometimes helps to stimulate the economy. And then looking at the different sectors, what are the biggest inflows? We're seeing that going into communication and ETFs, which when you run into more challenging times, folks tend to get into more passive investments. When we're really, let me take that back. When we're in more of a solid trend, folks get into more passive investments. When the market's really chopping around like it was in 2022, that's when they tend to turn over the reins to a manager to let them manage their funds for them, which is an active management type of an approach. But we're seeing a lot of money coming out of tech right now. It's a little bit of a surprise. Not really a surprise, though. We're also seeing some money coming out of energy. And looking at, this is the market implied U.S. recession probability. When you take all this stuff together, and it's really been declining. There's a 39% chance based on all these statistics that we're going to go into a recession. So it's really lowered from where it was before. This is interesting. This was put out by Tom McClellan, and it's called the NR7, but right now we're at an NR4. That means narrow range. And if you look at these little dots here, that means that we've had 4 narrow range days now. And that's what I was talking about at the beginning, where this could be a coil where it's like it's winding up. And is it going to shoot to the upside, or is it going to shoot to the downside? Now, if we get to an NR7, that would be over into next week, and that would really be strange. And then looking at when the core PCE comes out, what is that going to project going forward? Depending on what we get in the reading, is it, if it's up 0.1, 0.2, 0.3%, and then so forth, and then what that translates into on an annual basis going forward, we're probably going to want it to be around this gray area, maybe up to the yellow area, and that would be a 0.2 to 0.3 reading in here. So if it comes in hotter than that, that means inflation is really going to be projected higher. If it comes in lower than that, that could be more market friendly for the market as well. And then just to keep an eye on this, when the Fed is in the process of making slower rate cuts, that tends to be positive for the market. When they're making really fast rate cuts, that's in response to something really bad that has happened, and that tends to be negative. Here's our intraday chart. Look at this, 4 days now, just sleeping along, going sideways. We came down and pretty much opened at S1, and we got up above the daily pivot, but we never went positive for the day. This was acting as overhead resistance. We chopped around between the unchanged level and S1, and then we closed just a little bit below the daily pivot here going into the close. Here's our intraday chart. Not an awful lot to really see here. We did end up showing more weakness in the pre-market session, which then bled over into the cash session. We're up a little bit in the initial overnight session here, and we're still seeing where the red line is on top of the blue line, so value continues to outperform growth on an intraday basis. And we're chopping sideways, and we're negative here, and that's also showing that value is outperforming growth with the S&P, but we're not necessarily falling apart. For this to turn more positive, we want to see this ratio going back up. Looking at some end of day charts, growth was down with the large caps where it was up with value. It was up with the mid caps where it was down with value for the mid caps, and down more with the small caps than it was for value for the small caps. And we're still hanging okay in here. When we look at the growth to value ratio for the small caps, we're still breaking out and hanging in there for right now. Also, still hanging in there when we look at mid-cap growth to mid-cap value. And when we look at end of day S&P growth to value, we're not breaking out, but we're not falling apart either. And we're hanging in there okay with our discretionary to staples ratio. So this is showing a little bit of strength here. But when we look at our trend, we're still right on top of the moving average. The green line is coming down and we're just starting to drop below 40, but we still default to positive. Also just barely dropping below 40 with the green line with the short-term chart and on top of the moving average. Volume continues to drop off as we've been chopping sideways. Not really any change, but not a lot of fear when looking at the Ulcer Index. We ticked up a little bit with the line chart when looking at the VIX, and we're back up into the moving average range looking at the bar chart. We ticked up a little bit with the VIX of the VIX. That could be a little bit of hedging ahead of the PCE report coming out. We are dropping off, though, with the VIX, where we had been seeing a longer-term climb with the momentum since the beginning of the year. Actually, since the beginning of December. Now the VIX is starting to trail off a bit. Looking at our daily chart of the equity put call ratio, it declined. And so more in the positive camp, we're starting to turn down with our 5-period moving average of the equity put call ratio. Here's the latest reading from Investors Intelligence. We're still looking at a pretty extreme positive reading, even though it could go higher than where it's at right now. Advanced decline line, we're still hanging in there okay based on price. We're still seeing a bit of a negative divergence here where we're not really breaking out based on volume. We're still looking good with this internal measure, with the new highs picking up and our 5 periods going up and our 10 periods going up. So that internal measurement is still looking pretty strong. We're still looking okay here with our advanced decline ratio. We're above 0. Accumulation distribution is still positive. We're pretty much flat and coming down slightly with the moving average with the Chaikin money flow, continuing to decline with the Chaikin oscillator. Our advanced decline line studies, not a big change, a little bit of a decline with the NYSE common stock, a little bit of an advance with the S&P, pretty much flat with the mid caps and a bit of a decline with the small caps. So here's our daily chart. We're still hanging in there above this upward sloping trend line for right now. That will be the first line of support if we see some weakness. Down on the bottom, you see where volume is just dropping lower and lower each day. Not much of a change with our 20, 50, and 200 period moving average studies. We declined a little bit with the force index, and we dropped a little bit below the midpoint. With our short-term stochastics, we're just barely coming out of being extreme positive. We're turning down and still slightly extreme positive in the intermediate term. We're still going up and extreme positive in the long short term. We're not extreme with our standard deviations chart. We're in the +2 channel. Intermediate term, the balance of power declined, but still above zero. The go, no-go system is still positive with the darker blue bars. We're coming off of the highest high line here. That's the blue line, but we're still above the advancing midpoint. The TTM squeeze, it's looking a little bit like a checkerboard. It's turning back to a darker shade of blue, which is positive, but with a negative slant. The ease of movement did decline, but it's still above zero. We are declining after being extreme positive with the Arun. And we're still above zero, even though we declined with the SME McClellan oscillator. So we're going up with the summation index based on price and volume, but we've been really chopping sideways here. These lines like to move in one direction or the other, and they've just not been doing that lately. We dropped a little bit negative with the NYSE McClellan oscillator. So we're just barely starting to turn down based on price with the summation index. We're still continuing to advance based on volume. We're still looking positive with the Swenlin trading oscillator based on price and volume since we're above zero. And here's our oscillators. We're looking a little more positive when we just look at price, but we continue to be going sideways on top of the moving average based on volume. We saw a bit of a decline with the PMOs that are rising, a bit of an advance with the buy signals, and we're starting to go up slightly with the PMOs that are above zero. We continue to be neutral with the Elder's impulse system for the S&P. We continue to be positive with the parabolic SAR. The slope is flattening out here and slightly above its moving average. The MACD is also flat, pretty much flatlining right now, slightly above its moving average. So we're not really getting anything here as far as the momentum. It's pretty much flattening out on all different time frames. We're still above all of our plotted moving averages. If we start to fall, we drop below the trend line, we will be watching the 20 period moving average. This is more positive. We saw another little tick up with the bullish percent index, and we're not necessarily extreme. It had been declining. It had been showing us a negative divergence. The fact that we've seen 2 up days now is positive. And we did tick up slightly with the NYSE bullish percent index, but we went down with the NASDAQ 100 bullish percent index. We're declining, but still barely above 50 with the money flow. We're turning up and above 50 with the ultimate oscillator. We're declining, but the green line is still on top with the vortex. We're still looking positive with both of our RSI charts. Most of the recent readings have been above 50. On balance volume continues to be above an advancing moving average. We ticked down just a little bit with our 20 period moving average study, but we're also seeing this longer term negative divergence. Also, this longer term negative divergence with the 250 period moving average studies. The Copic curve continues to be negative. The Sean trend meter is coming down after being extreme positive. This is a new take on Dow theory where we've been setting recent highs in the Dow, but we've not been setting them in the NASDAQ. Now, right after this, I've added a new study. This is another way of looking at Dow theory using the S&P equal weight, which is setting all-time highs, and comparing it to the QQQ equal weight. Instead of the NASDAQ, I'm using the NASDAQ 100, but the equal weight version of that ETF. And this is confirming each other. So this is also suggesting that we're seeing more broad market participation because these are equal weighted indexes. Our charts looking a little more doji-ish here with the hike in Ashi. We've seen 2 doji candles in a row. That's where they open and close right about at the same point. We're still positive with the Kegi, but now pointing down. We're still positive with the Renko, and we're still positive with the 3-line break. Long term, we're still above this trend line, and it has been providing some support for us. If we break below that and then close below it, that could signal that this trend is in jeopardy, and then we'll be watching the 20 period moving average, which is not far below that. This is another area that we're keeping an eye on. If we go up from here, we're looking at the 5111 level. That is this pivot point that we hit last Friday. We stalled right at that point. We're not too far away from it. If we do get a nice positive bounce, we'll be watching that level again. We're also working the scenario that we hit that last Friday, and maybe that's the last we'll see it for a while if we continue to drop from that level. Then looking at the long term, we're still extreme positive with our 150 and 200 period moving averages. We're still looking okay with the Keller market model across all of the different indexes. And we had mostly positive alerts that were triggered in the Wednesday session here. Nothing all that spectacular, really nothing for the S&P since it barely moved. We're also keeping an eye on this. This is a total US stock ETF, just suggesting that we're close to all-time highs here. Yes, it's the Magnificent Seven that have really been contributing to the indexes going up, but there's other stocks that are also participating. The equal weight is actually starting to outperform the S&P weighted index, and we're going down slightly with our ratio here, which also suggests that the equal weight is outperforming. The Dow is still above this pivot point for right now. We continue to be neutral with the Elders Impulse system for the diamonds. We're also chopping around with the NASDAQ, and you have a pivot level, but it's a little bit below current price. Also, we have another pivot level here with the NASDAQ 100, also been chopping sideways, and we're down a little bit more in Wednesday's session. We switched from being positive to neutral for the QQQs when looking at the Elders Impulse system. We're still negative with the momentum with the NASDAQ 100. And we're also keeping an eye on this longer term. This is the ratio between the NASDAQ 100 and the Dow. We're coming back up to previous high points that often marked a reversal. We're wondering if that's going to happen again this time. Small caps still hanging out above their 50-day moving average. So they're holding up a little bit better. We're not seeing as much give back as what we've been seeing in the past. But we switch back over to neutral for the Elders Impulse system for the small caps. This is looking a little better when we look at the Russell 2000 small caps. We're above this support level here. We're above the 50-day moving average. We have a longer-term uptrend, and the momentum has switched to positive. Even though we declined, we're still above 50 with the RSI. This is a chart put out by Real Investment Advice. This is a longer-term chart of the small caps looking at the Russell 2000 ETF. Here's the all-time high that was set. And then here was the high set in late 2023. And we're kind of right at this point right now to see if we can break above this trend line, or is this going to provide overhead resistance and we're going to come back down here. But for right now, looking at the MACD, the momentum is positive, and the RSI, as I pointed out in the other chart, we're still above 50 and showing some advancement. But this is now a day old on this chart. The mid caps are still pretty much chopping sideways, still above this pivot level. And the mid caps for the Elders Impulse system have switched back over to neutral. The FANG index is chopping sideways as well and close to all-time highs. The financial sector was up slightly and still in an uptrend. We're keeping an eye on New York Community Bank, which has now kind of gone into a sideways pattern. The dollar was up slightly, and we're above both of the moving averages. We were down with the 10-year yield. We were up with the 10-year based on price. And then looking at our growth to value ratios, turning down just a little bit with the Qs to S&P, showing a bit of an improvement and climbing above the moving average when we look at discretionary to S&P. We did decline, but we're still above the moving average when we compare large cap growth with large cap value. So with the large caps, we're above the moving average, mid caps and small caps. So the different indexes are looking okay. It's more of a discrepancy between discretionary and the QQQs that are causing a bit of a problem right now. We're still positive with the 5-day moving average of the highs minus the lows across the Amex, NASDAQ, and NYSE, and we're still extreme positive with our 10-day average of the S&P 500 highs minus the lows. So what's our outlook for Thursday? We're positive. I've taken the overbought off of here for right now and just say that we're holding up. We're slightly overbought because, and that's mostly having to do with the long term, the 150 and 200-day moving averages. We do have overhead resistance if we go up. There could be some weakness that's starting to come into the market, but we're hanging in there for right now, and we are dealing with a period of time that historically has been weak from a seasonal perspective. We're going to get weekly jobless claims, and this is the big one: personal income and spending and PCE prices, the Chicago PMI, and then pending home sales. And then we want to keep an eye on the different geopolitical events. In Friday's session, we're going to get ISM manufacturing. That's another big one, as well as consumer sentiment. Seasonality. We don't get many February 29th, so I was kind of surprised that we actually had some statistics here, but we're negative across the board with the Dow, S&P, and NASDAQ. Everything is not good on this day. Seasonally, going into the end of February, we do see some seasonal weakness, and now I've tried to stretch this out a little bit. We have February and then going into March, where we might get a little bit of a bump at the beginning of March, but then we tend to see some seasonal weakness after that. And then the gains that we see during an election year usually come after that dip that we see in March. Then when January and February are positive, that tends to do well for the market going forward. We're still wondering if we're coming down into this dip time now with the Stock Traders Almanac statistics. This is also suggesting that we may see some weak seasonality. And we're on the last day of February, which is the worst of the best 6 months. March tends to be better, but sometimes it can start off good and then get bad for a while and then turn better as we go forward. Thursday is one of the more positive days of the week, so we'll have to see how things go that way. We're on the last trading day of the month, the 20th trading day, where we do see some weak seasonality going into the end of the month. Also, Tom Bowley is suggesting that we're seeing weakness going into the latter part of February. When we look at March, we do tend to be up more than down when we go back to 1950. And then when we go from 1950 to 2023, we're also up more than down, and we tend to have a positive return for the month of 1.1%. So we're not really going with the down scenario yet. If anything, we would still go with the up scenario, but we want to see some strength. We want to get out of this narrow range that we've been in. We're not going with the sideways trend for right now, because even though our ADX is right on top of its moving averages, they're still above 20. So the warning signs: on a general basis now, volume has been decreasing as we've been going up, but we had a slight down day on Wednesday and volume still continues to drop off. We have a whole list of negative divergences with our oscillators, the McClellan oscillators, and the summation indexes. The S&P and the small caps and the mid caps, when compared to the S&P, discretionary to the S&P, the transports to the Dow and S&P, and the transports are looking even weaker right now. The Copic curve is negative. The NASDAQ 100 bullish percent index is still below 70, and the momentum for the NASDAQ 100 is also negative, and we're also in a weak seasonal time. On the positive side, for right now, growth is holding up. And I went through those charts, and it's not really going in with any gangbuster strength, but it's still hanging in there. The equity put call ratio, I've switched that over to the positive slide here. It's now starting to go down. The parabolic SAR is positive. The oscillators are really positive, but pretty much chopping sideways. The vortex is positive. Small and mid cap growth is positive. The financial sector is positive. So our conclusion: we're dealing with overhead resistance. That's if we go up. Weakness could still be developing, and we're dealing with weak seasonality. That's if we tend to go down. So you can justify up or down from here right now. What it's not looking like is a blow off top from last Friday. That's what it looked like it could be developing. We've seen that before. We hit that upper resistance, we turn, and then we go in the opposite direction. So far, that has not happened, but weakness could still develop from here. In the short term, we still are seeing some potential weakness, but for right now, we're still positive. Intermediate term, we do have that overhead resistance to be aware of. Long term, we're still overbought with our 150 and 200 period moving averages. Thank you. I hope you found this helpful. I hope you have a great day. Maybe I'll have something exciting to report on for Friday's video, because we get out of this sideways action that we've been seeing. Have a great day, and I will talk to you in the next video.